the broadcast a couple of minutes early. Welcome everyone to the FAIRtax webinar hosted by the Florida FAIRtax Educational Association, but it's for everybody. And our topic tonight will be the effect of the FAIRtax on the growing national debt. The presentation, as usual, will be by Jade Walle, who's a CPA from the Colorado area. And he'll be with us in just a minute. We're going to wait a couple of minutes till 8 o'clock to make sure everybody has time to log in. And if you have questions, there is a chat section. Try to avoid using the chat section. Try to use the question and answer period that, at least on my screen, is below the main window. Because otherwise we're chasing questions in two different locations and it's kind of hard to keep up with. Okay. Hope everybody is having a nice September. And my wife and I are actually away from home right now, and we're hoping that when we get home, it's going to cool off a little bit. Okay, it's 8 p.m.
I'll upload here, Ron.
Jade, why don't you, there you go.
Okay.
Jade's got his PowerPoint up there. And take it away, Jade Walle.
Thanks, Ron. Appreciate everyone being here tonight. If you are just tuning in and didn't hear Ron earlier, we've got Ron and Elaine Malero, and also one of the FAIRtax experts on the National and Florida Board, Randy Fisher, available to kind of answer questions as we go and at the end. There is a question box in the webinar format that you probably see, and feel free to type questions as you go. And if we miss them as we're presenting, we'll definitely have time for Q&A at the end of the presentation and circle back with you there. Special thanks to Ron and Elaine Malero. We invited Ron and his lovely wife Elaine out to Stillwater, Oklahoma to present about the FAIRtax at Oklahoma State University in a graduate accounting practicum course. And that was just a ball. And for those of you who have never met Ron and Elaine in person, but probably listened to Ron on the FAIRtax Power Radio episodes, they are just as cordial and wonderful and nice in person as you might expect them just from listening to them. So special thanks, because they always do so much behind the scenes work in getting these webinars ready to go in the logistics and in the format. So special thanks, Ron and Elaine. Appreciate you guys.
Thank you.
You bet. Let's go into our agenda here today. As always, for those who might be a little bit newer to the FAIRtax, we're going to have a brief introduction to what the FAIRtax is. What exactly is it, and what does it replace, and what's it all about? And then we're going to go into our topic for the evening about how the FAIRtax would affect our national debt, or if it would at all. And then we'll conclude and go into a period of Q&A. One of my favorite pictures there. So the FAIRtax. First of all, what are the principles of the FAIRtax? The FAIRtax creators based the FAIRtax system on the following guidelines. The FAIRtax must be simple, fair, voluntary, transparent, border neutral, and industry neutral. A key concept here was there were no favorites and no winners or losers. It is completely nonpartisan. This isn't a Republican or a Democratic proposal. A key tenet of the FAIRtax is that it is fair. This means that items are taxed once and only once ever. So if you buy a new item and pay the FAIRtax, when you sell it as a used item, the new purchaser doesn't have to pay the FAIRtax again, and you as a seller of a used item do not have to collect the FAIRtax. So what is the FAIRtax? It's a national consumption tax. It broadens the tax base in America by almost 100%. We go from a $5 trillion taxable income base to a $9 trillion taxable consumption expenditure base. And those numbers are a little bit stale, and I have a feeling they're a couple trillion higher by now. The great thing about the fair tax is that it is based on the core principle that there are no winners and losers. There are no exclusions from our nation's consumption of new goods or services except for higher education, which is deemed an investment, and the sole exemption out of the entirety of the fair tax. So it's a national consumption tax on purchases of all new goods and services, currently estimated to be at 23% inclusive rate, in order to be revenue neutral, meaning it is not a spending reduction plan, but simply a different and more efficient way to bring in the same Treasury receipts that are currently collected under the U.S. Income and payroll taxes. So although the fair tax is revenue neutral to our U.S. Treasury receipts, it drastically reduces, if not almost entirely eliminates, the nearly $700 billion of annual illegal tax evasion that we experience under our current income tax system, based on current published IRS data. We'll discuss how a little later. Next, income and payroll taxes are eliminated under the fair tax. There are no more income taxes for individuals or corporations. This means that there are no individual or corporate income tax returns to file, no consumer record keeping requirements, no more shoe boxes full of receipts. The fair tax replaces about 96% of our current federal tax receipts. It doesn't replace a few minor items like the federal gasoline tax that we don't even realize we're paying at the pump, kind of an excise tax. Specifically, however, it eliminates and replaces the income tax, the corporate tax, the alternative minimum tax, the death tax, also known as the estate tax, capital gains tax, self-employment tax, gift taxes, and FICA, which is the Social Security and Medicare tax, which is, by the way, the most regressive tax of all and has the horrible effect of hitting the working poor the hardest. Actually, over 40% of all tax receipts in our U.S. Treasury come from the payroll tax, meaning almost half of our Treasury is based on the most regressive of all tax schemes imaginable, hurting our working poor head on. What else does the fair tax have? It has a prebate. The first argument against the fair tax, when people hear it's a sales tax, is that it's regressive and will hurt the poor, meaning that a flat sales tax is much harder to pay for the working poor relative to people who are wealthier. Let me address this straight away. The fair tax is not regressive. It includes a monthly prebate to all U.S. citizens, reimbursing them for the fair tax spent on the basic necessities of life, based on annually published U.S. Department of Health and Human Services poverty levels. For example, based on the 2019 DHHS poverty guidelines, $33,820 is the annual poverty level for a family of four, which means $7,779, and that's the $33,820 multiplied by the 23% rate. $7,779 would be refunded in advance, called the prebate, back to that family. That's $648 at the beginning of every month, up front, to reimburse that family for the fair tax that they'll pay that month on their expenditures up to the poverty level. So they're effectively untaxed for spending on the true necessities of life. This is similar in concept to a standard deduction now, but works even better. And when you dig into the fair tax plan's research studies, the prebate actually makes the fair tax more progressive than our current graduated income and payroll tax system when you crunch the numbers. And I've looked at the studies and it's math, and it's true. It's just pure math. This means the effective rate of tax you pay on your consumption gets higher and higher the more you spend, the richer you are, due to the prebate. Although the fair tax is a single 23% rate, the prebate injects an incredible amount of progressivity into the fair tax consumption rate structure. Okay, next, embedded taxes are eliminated under their fair tax. The fair tax also eliminates embedded taxes that have ingrained themselves into the cost of every good and service we purchase and consume every day. A study undertaken by Dale Jorgensen, the head of Harvard's economic department at the time, concluded that on average, about 22% of the cost of everything we purchase is made up of embedded taxes along the way. So what does this mean? It took me a while to get my head around it. A few examples are where an employer must pay the 7.65% FICA match for every employee's wages that they pay. Sometimes we forget that the 7.65% FICA tax we pay each paycheck is also mandated by the income tax code to be matched by our employers. So it is another cost of doing business that gets embedded into the cost buildup of whatever products we buy. Also, consider the federal income taxes that corporations pay. Again, another cost of doing business that gets ingrained into the total buildup of the costs that they then add on to their profit margin in determining the final retail consumer prices we pay. At the end of the day, the studies showed that depending on the industry, around 22% of the cost of what we pay at the register is embedded taxes for any good or service. All of these embedded taxes will fall out of the cost of goods and services we purchase as soon as inventory makes one turn, meaning very quickly within the first year of fair tax enactment, depending on the product. The elimination of embedded taxes will also make our U.S. made goods much more competitive abroad and help reduce our trade deficit. We'll go into that in a little bit more detail here shortly. With competition in efficient or at least semi-efficient markets, prices will come down drastically. Some espouse that retail companies will just pocket the extra profits since their costs are going down and not pass along the savings associated with paying no federal income tax and no FICA employer matching tax, and prices won't drop at all. Economic principles and history prove this perspective flat wrong. The great thing about a free market system is competition. And with competition, it's all about market share. Now, will prices come down 22% on average? There were some studies that believe that prices might come down just a little bit less than 22%, since employee wages are sticky things, as Alan Greenspan famously once said. This gets a little deep, but what this means is that since individuals will now pay no income tax or payroll tax withholdings, in theory, we could all offer our employer our labor at a lower salary or wage, which would be some portion of the 22% price drop expected by the Harvard economic studies. In actuality, prices might only drop 15, 18% rather than 22%, given the large portion of labor that remains in many industries, but still represents a tremendous drop in prices for the new goods and services we consume. So who pays the fair tax? Everyone in the U.S., whether we are citizens, visiting here for tourism, legally immigrated here, or staying here illegally. Anyone who spends money on new goods or services, whether they gain their income from legal law-abiding salary and wages or underground illegal and otherwise nefarious means, they'll be paying the fair tax when they consume. What if I buy used goods? A key tenet of the fair tax is that it is fair. This means that items are taxed once and only once, ever. So if you buy a used car, you're not paying the fair tax. If you buy a used home, and in 2017, nearly 90% of all home purchases were used, you don't pay the fair tax. How is the fair tax collected? It is collected by vendors at the retail level only, just like they currently collect state sales taxes. Currently, 98% of the U.S. population pays some sort of state sales tax in their respective states. Vendors then remit their state sales to their state sales tax authority, but they not only will remit their state sales tax collected, but also the federal fair tax collected. But for their troubles, they'll keep 1/4% of those funds as a collection fee. So 1/4%. If you remitted $1 million in fair tax collected, that'd be $2,500 you keep for yourself as a collector's fee. The states then remit the federal fair tax collected from all the vendors in their state to the U.S. Treasury each month and keep for their troubles 1/4% of the funds collected. Compare this to the 155 million individuals and 100 million businesses that are tax collectors under our current income tax system. Each of us individually as a family, filing jointly or individually in businesses, are basically tax collectors that aren't paid a dime for our tax collection services for the IRS currently. The vendors collect the fair tax at the register, and the Fair Tax Act specifically calls for the amount of the fair tax to be clearly delineated on your receipt, so you can always tell how much you're paying in fair tax. And I suppose if you were so inclined, you could save all your receipts and calculate how much in federal fair tax you paid for the year. But the great thing is you don't have to under the fair tax. There will be 250 million people in the U.S. paying their fair tax almost every day. You know, I know that the population's 330 million, but let's assume the infants up to 10 years old aren't really consuming that much by themselves. So 250 million people paying the fair tax every day, and yet the payment of your fair share of the federal income tax burden will be completely anonymous at the register. If there are any issues with tax remittance violations, the vendors are the ones who have to answer, not the consumer. With the fair tax reimbursed for your necessities needed to survive and live thanks to the prebate, your true unreimbursed federal tax expenditures are finally voluntary rather than compulsory. The fair tax only taxes us at the retail level where new goods or services are purchased or consumed. So this means that of the approximately 100 million total US businesses, of which around 2.5% are retail businesses, only 2.5 million businesses would need to collect and remit the fair tax. This then also means that the vast preponderance of businesses have absolutely no tax compliance costs, no tax burden, and no tax remittances whatsoever. And finally, to avoid the potential of both a sales tax and an income tax like many European countries, the Fair Tax Act specifically mandates that the 16th Amendment, adopted in 1913 that allowed the income tax, must be repealed within 7 years after the fair tax becomes law. This must be a separate legislative process. It can't be in the Fair Tax Act because a constitutional amendment, as you know, requires 2/3 of the House and Senate to pass and 3/4 of the states to ratify. So it has to be a separate legislative process. So let's introduce the topic before we switch slides here. The fair tax is a revenue neutral concept, and it is configured to be a national sales tax rate that brings in the same revenues to the U.S. Treasury that our current income and payroll tax system does, about $3.3 trillion a year. On its surface and in the Fair Tax Act itself, there is not one word about federal spending or reducing or increasing it. It is simply a different, more efficient, and practical way to bring in our needed U.S. Treasury receipts. However, there are several indirect concepts, if you will, that I contend will lead to an eventual decrease of our growing national debt and annual budget deficits that build up into the debt. These concepts, and there are too many to examine in totality today, we'll focus on tonight, and they include the effect of drastically reduced tax evasion on our national debt, the effect of dramatic U.S. economic expansion and the effect on our national debt, the effect of eliminating virtually all income and payroll tax compliance costs and hours, and how the fair tax affects the overall transparency of our U.S. Treasury receipt system and the ultimate effect of this on our national debt. So let's jump into our first topic here. And forgive the busyness, there's just so many captions and pictures. I wanted to get them in here. So tax evasion. With the fair tax, there will be less evasion, which equates to increased tax collections, which yields less of an annual budget deficit, which works to either reduce the national debt or at least decrease the rate by which the national debt is increasing, a decrease and an increase. So let's look at some current tax evasion statistics. Based on a recent 2017 study by Dr. Sabula, there is currently $700 billion a year illegally evaded by Americans or anyone who is supposed to file a U.S. income tax return. But given the dynamic gig economy we live in, this is forecasted to grow even higher to $1 trillion a year by 2026, just 7 short years away, even though it kind of sounds like a lifetime away. The illegal evasion rate is growing exponentially faster than our own U.S. GDP. Let me give you a quote here, and we'll dive into evasion. Adam Smith, author of Wealth of Nations, might recall him from the 1700s. He said, "The property which every man has in his own labor, as it is the original foundation of all other property, so it is the most sacred and inviolable." And everyone kind of seems like they spoke like Yoda in the 1700s, so I know it's a little bit disjointed, but we get the gist, and you see the picture here on the left. Let's explore what this means in the context of fraud or theft, which is what illegal tax evasion is. Financial statement auditors learn in generally accepted auditing standards about a concept called the fraud triangle, and you'll see the middle picture here. We find in business when 3 aspects are present, that's pressures, rationalization, and opportunity, fraud is bound to occur and frequently does. The key aspect in the definition of fraud is that it is an intentional act, like intentional illegal tax evasion, as opposed to legal tax avoidance or accidental error. So let's examine these 3 aspects and how the fair tax might play in. Pressure. This also is sometimes referred to as incentive. This aspect of the fraud triangle is always present with human beings and has been as long as we've been on Earth. All of us can feel pressure or feel incentivized to cheat. In this case, as it relates to defrauding the U.S. government of the taxes it is due by not filing a tax return, by filing a false tax return, usually in the form of excess deductions or underreporting income earned. Perhaps someone has a gambling problem, a mistress, or just out of control bills at home. The pressure that mounts from these circumstances, often brought on by our own behavior, can be a significant factor in fraud. Rationalization. The Adam Smith quote we just mentioned and that you see on the screen really digs deep into our human psyche. If we perceive our hard work, our labor's rewards, our paycheck earnings as the most sacred and inviolable property we have, it is easy to see how we are all hardwired to really rationalize and justify our cheating of the income tax. We're not encouraging anyone to do so, but it is easy to see how a small business owner, for example, trying to make ends meet, take care of their family, pay for school, medical bills, dance class, etc., can rationalize in their mind how the government spends on foolish things anyway, how paying the employer matching and employee portion of FICA self-employment taxes seems excessive, and how they feel they already pay enough in taxes. With this mentality, it is not a big step to reporting excess deductions. Perhaps that personal vehicle becomes a business vehicle, or underreporting income, not reporting as income some of the business's cash receipts, for example. These are simple examples, and most small business owners report and pay their taxes correctly. Make no mistake. But all in, there's over 20% of the nation's annual tax revenues due that are never collected, which totals about $700 billion a year right now, quickly moving towards $1 trillion a year by 2026. The income tax aggressively goes after what we perceive as our most sacred property, which right off the bat is a bad focal point for a treasury system to base its tax collections on. Well, we made a mistake 106 years ago with the 16th Amendment in 1913, but we're smarter now, and perhaps our sophistication of the psychological sciences has advanced. So let's move on to opportunity. The most critical leg of the fraud triangle's three-legged stool is opportunity. If opportunity is removed from the equation, fraud or theft cannot happen. For example, if an employee feels pressure and can rationalize that he or she needs to steal from the business in the business's cash register, if the drawer is locked with CCT monitoring, the opportunity to steal is removed or reduced to an acceptably low level, and fraud and theft does not usually occur. Under the FAIRtax, the vast majority of opportunity to defraud our U.S. Treasury is eliminated because we're no longer on our honor mandated to report our income, claim our deductions, remit our taxes. Tax evasion is virtually eliminated under the FAIRtax. And as 1.3% of all U.S. businesses account for about 75% of our gross receipts for purchases at the retail level, this will allow enforcement to be concentrated on large vendors. Think Walmart, Best Buy, Target, Starbucks, Amazon. And historically, these large companies have never had issues in collecting a state sales tax at the register or checkout page, and would not want to risk enforcement actions, bad press, and scrutiny for absconding with FAIRtax receipts. The FAIRtax basically eliminates 150 million individuals and nearly 100 million businesses from being tax collectors for the IRS, which by itself takes the hazard out of play, so to speak, as it relates to opportunities for tax evasion. Plus, the retail vendors in 50 states that collect the FAIRtax and remit it to the Treasury get paid for collecting taxes. 0.25% of their collections are kept by the vendors in the state for their troubles. I'm not sure about you, but last time I filed my tax return, I made estimated quarterly payments to the IRS. I don't recall receiving any kind of payment for my troubles, which are extensive and very time-consuming, by the way. So evasion, that's going to drastically decrease and increase our coffers. So let's move on. Economic expansion under the FAIRtax. Bottom line, our U.S. Treasury will collect more in tax receipts in a booming economy with the U.S. as the tax haven of the world, as opposed to an economy that is not booming. Many of the grassroots funded studies of how the FAIRtax would affect the U.S. upon enactment were conducted by the former head of the Harvard Department of Economics, Dr. Dale Jorgensen. Here are just a few of the many statistical results as to how the FAIRtax would affect our U.S. economy when it replaces our antiquated income and payroll tax system. Real wages. After 1 year of FAIRtax enactment, real wages rise 10%. Same thing after year 10 and year 25. Disposable personal income is up 2% in year 1, up 9% by year 5 and up 12% by year 10. Consumption is up 2.4% year 1 and is up 12% by year 10. These are massive figures that are almost hard to fathom. US GDP increases 2.5% year 1 and is up 11% by year 10. Until the last 2 years, real wage growth has been stagnant in the US for decades, when factoring in inflation and the like. Even in the past 2 years, and not to complain, but 2 to 3% real wage growth these past 2 years has done wonders for our economy. But just imagine 10% real wage growth and the effect to our national morale, working families, our lower middle class, and the overall economy as it relates to consumption and increased disposable personal income. Now, the fair tax cannot keep the burgeoning U.S. Treasury coffers from being spent foolishly, but it does drive greater collections that are not factored into the current fair tax rate, which is based on a status quo economy, meaning the fair tax research, which calculated the needed national sales tax rate, does not factor in aggressive U.S. economic expansion, irrespective of the economic studies that highlight that the fair tax would yield an economic boom in the U.S. unlike anything ever seen. And we've seen a lot relative to the rest of the world. For those skeptics, the key point that boils it all down is the fact that the tax base under the fair tax nearly doubles relative to that of the income and payroll tax. These are stale figures again, but the current income and payroll tax base is approximately $5 trillion, whereas the fair tax consumption tax base is $9 trillion. Although consumption is made up of income, borrowing, savings, and theft, while the income tax is only comprised of income, so it's not hard to see why consumption is more than income, the actual income subject to taxation in the US would be much higher if it weren't for the multitude of exemptions, exclusions, deductions, and credits that lower our otherwise large income tax base down to only $5 trillion. Under the fair tax, there were no longer any economic, tax evasion, or avoidance advantages to keeping money offshore. This will result in trillions being repatriated and put to use in our U.S. communities, our charities, our businesses, and our economy as a whole. A few years ago, Alan Greenspan was asked how soon the estimated $14 trillion in offshore funds would repatriate under a U.S. fair tax regime, and he replied that it would be a matter of weeks or months as opposed to years or decades. All aspects of the underground economy, which is estimated at trillions of dollars annually, see the light of day and are finally taxed under the fair tax, since criminals or others who might be in the country illegally have to consume to live and will finally pay their full federal burden at the cash register, expanding the tax base significantly relative to our income tax. Another unexpected fair tax economic stimulus is that U.S. goods immediately become more competitive relative to their non-U.S. competitors from other countries. How and why does this happen, you may ask? Well, the fair tax acts as a dagger in the heart of the trade deficit, since all embedded taxes are removed from the cost buildup and ultimate selling price of goods produced in the U.S. and exported abroad. As an example, when European countries and many other countries who employ a VAT tax, that's a value-added tax, export their goods abroad, the government refunds the built-up accumulated VAT taxes to the local producers, thus lowering the price of those goods being sold, effectively eliminating embedded taxes from their retail cost abroad, making those goods much more competitive relative to the U.S. Lower prices tend to win the day most of the time, right? Historically, since the U.S. is the only one out of 30 OECD members, that's the Organization for Economic Cooperation and Development, 1 out of 30 members that is not a VAT tax system, our embedded income and payroll matching business taxes included in the goods produced in the U.S. are ingrained deep down inside somewhere in the cost and resulting retail price of those goods we Americans sell abroad. This has kept the U.S. at an incredible disadvantage relative to the rest of the world for decades, while also manifesting itself in other ugly ways such as reduced R&D and less innovation, reduced distributions to owners and investors. That means lower 401k and IRA returns for our senior citizens, and the ugliest of them all, reduced employee salaries and wages. Within the fair tax, U.S. produced goods will finally be able to compete on a product's merit, its utility and usefulness to the consumer, as opposed to having an automatic 22% cost disadvantaged relative to the rest of the world. This would truly make America competitive again, something that our current tax code is incapable of doing. And that, coupled with a 0% corporate income tax rate, it will be the tax haven of the world in America, and will actually almost be too hot of an economy because everyone, their brother, their cousin, and their dog will want to do business here. Switching gears, most of us can agree that education is a key, not the only key, but a pivotal and needed key to ensuring economic success and prosperity in any society. Ron, you're one of our co-presenters here, as a former educator, can attest and agree with me, I'm sure. The fair tax completely untaxes education expenditures, since the fair tax considers education an investment, and when you make those tuition payments, you won't pay the fair tax. Relative to the current income tax, which requires tuition payments with reduced after-tax earnings, the fair tax makes college tuition around 40%, almost half, almost 50% more affordable relative to our current system. It is clear that the more educated our country, the more innovation, breakthroughs, higher earning jobs, and prosperity the entire nation will experience. All of these things which would work to reduce our national debt. Another aspect of U.S. economic growth will come from the fact that the current uber regressive payroll withholding taxes on our working poor will be completely eliminated under fair tax. Our regressive payroll tax makes up greater than 40% of our Treasury's tax receipts, and 75% of Americans pay more in regressive payroll taxes than they do in income taxes. It's incredible the burden working poor and middle-class families shoulder as it relates to our U.S. Treasury receipts. The working poor will finally get a leg up by being able to keep their entire paycheck without the federal government demanding that the working poor pay nearly 10% of their earnings off the top first thing to the U.S. government in the form of FICA and Medicare payroll withholding taxes. Now, the working poor in this country, armed with the hottest economy in world history, rising wages, increased purchasing power, a full fair tax rebate received at the beginning of each month, and no regressive payroll tax withholding, that is, a full paycheck to take home, will be an incredible economic stimulus in and of itself. And not to mention, the fair tax still funds Social Security and Medicare. Those entitlement programs do not change. They're untouched. This has nothing to do with it. We're bringing in the same Treasury receipts that still funds those programs. And we know that mental health issues play an increasing role in the horrible homeless epidemic affecting many large U.S. cities. Outside of these worthy issues, which are beyond the scope of the fair tax, many homeless and marginalized Americans will be able to truly have a shot at breaking the horrible cycle of poverty due to the fair tax's effect on our U.S. economy, and particularly our working poor, as we just went through. Economically speaking, we all know deep down in our soul that the current income tax is a 75,000 plus page monstrosity that was written by millionaires for millionaires, with over half of Congress currently at or above the millionaire designation. The common rule that plays out is that the top 20% of earners receive approximately 80% of the deductions, write-offs, exclusions, exemptions, and carve-outs, such as the home mortgage interest deduction and retirement savings deductions. When the fair tax is enacted, despite the onslaught of K Street lobbying opposition that will have been overcome by we the people, there will be no more special treatment for offshore accounts, no repatriation of funds gimmicks, no advantages bequeathed to us because of a certain behavior we start or stop doing, and no special deductions for the wealthy among us. Everyone, and we mean everyone, will finally be treated fairly, the same, with no winners or losers, except you pay more tax as you spend more. The only losers, if you can even call them that, are what would be described as the ultra wealthy, such as a Warren Buffett or Mitt Romney in personal life. The uber wealthy don't earn a paycheck anymore where they receive a W-2 and have payroll tax withholdings. They likely live on investment returns, which currently receive a much lower capital gains tax rate. Under the fair tax, as the wealthy spend like the wealthy usually do, which is quite a bit, millions of dollars a year, they will be paying the highest effective fair tax rate relative to working Americans because, with the prebate mechanism, the more you spend, the higher your effective tax rate. Finally, the Warren Buffetts and the Mitt Romneys will be paying into Social Security and Medicare, which they have not been doing under the current system since the day they stopped working as an employee. No FICA withholdings when you're just getting investment returns and paying capital gains tax. As far as senior citizens go in our economy, our elderly's net purchasing power will increase dramatically after FAIRtax enactment. Social Security checks will no longer be subject to up to 85% of those Social Security benefits being taxed by the US government, and any retirement savings can be freely spent with no limitations, no early withdrawal penalties, and no taxation on income that currently they're having to recognize when they withdraw funds from their 401k balances. Coupled with the prebate each month and no tax withholdings on any retirement jobs, senior citizens will see a large purchasing power increase under the FAIRtax. The question or conundrum that the FAIRtax will not remedy is, if an influx of Treasury receipts comes into our national coffers, how will Congress utilize the funds? That is, will they work to pay down the national debt? Will they increase spending on government programs? Will they shore up Social Security so it doesn't go defunct by 2033, as is currently estimated by the Social Security Administration? There are many scenarios here, all of which are dependent on the speed of U.S. economic growth and expansion after FAIRtax enactment, which, according to some of the brightest economic scholars from Harvard, would be immediate, expansive, and exponential over time. This question of what do we do with all the extra money coming in is what we call in the business a good problem to have. Lastly, as it relates to the economy, it is settled science that all learned economic experts agree that 3 items promote economic growth. There's really no argument on this. Those are: 1, replacing the income tax with a consumption tax promotes economic growth. 2, replacing a graduated rate system with a flat marginal tax rate system. And 3rd, low marginal tax rates with a broader tax base. Remember, 9 trillion versus 5 trillion. The FAIRtax hits all 3 of these economic growth requirements, not only out of the ballpark, but completely out of the stadium. So let's move on here. Compliance costs. With the FAIRtax, tax compliance costs, which are estimated about $600 billion a year in the U.S. Imagine that, almost $1 trillion a year just to comply with our antiquated, dilapidated, and intrusive federal income tax code. And about 8.9 billion hours a year are spent by companies and individuals, and these costs and hours will be dramatically reduced. We're talking 98 to 99% reduction. What effect would this have on our American workers and businesses and related business M&A transactions? For example, no tax effects with businesses considering whether or not the acquiree's net operating loss can carry forward an appropriate number of years to be utilized by the acquirer. And I'm just getting CPA techno-nerdy for a second, but the tax aspect of deals take up an immense amount of time in the boardroom and through businesses and individuals around the country. All of that's gone. What would be the effect on business productivity? What would be the effect on American businesses and individuals spending time in more meaningful tasks, initiatives, goals, endeavors, societal problems, etc., as opposed to 75,000 plus pages of arbitrary IRS regulations, rules, court decisions, and interpretations that slow down the efficiency of our already incredible free market US system? Remember, these $600 billion in compliance costs are another cost that will fall out of the current system that ends up in the retail price of goods and services we currently consume. The underlying studies that highlight that 22% of the costs of goods we currently buy are embedded taxes, they don't even include these $600 billion of compliance costs. So what does this mean? Costs of goods and services will actually fall more than the Harvard study indicated, given it was a conservative model that did not incorporate the elimination of these excessive compliance costs. There are roughly 100 million US businesses, which include corporations as well as small businesses and mom and pop sole proprietorships. Only 2.5% are retail businesses that sell to an end user consumer. This means that 97.5 million out of the 100 million businesses in the US will have no tax or record-keeping obligations relative to their current tax tracking, bookkeeping, and remittance responsibilities. The ultimate effect of reduced tax compliance cost, again, $600 billion a year, almost 9 billion hours of time spent complying with the code, it will be to organically and elegantly promote greater good being done with these 9 billion hours and $600 billion in cost, which have a direct effect on our economy with unprecedented worker and business productivity gains, resulting in even more fuel being injected into our U.S. economy. The side effect, which is actually a positive in this case, unlike the many prescription drug commercials we all see that are with some of the side effects that are hard to believe. In this case, the side effects is that America will have no more time, will have much more time, to focus on a simple system. And it ensures that any politician's attempts to pollute the fair tax with amendments, loopholes, exclusions, exemptions, credits, or deductions will be noticed and objected to by the electorate. While right now, many of us not trained as tax attorneys or CPAs in today's income tax world, we simply throw our hands up in the air and hope the income tax code that changes every few years doesn't put us in a bad situation or too far behind the 8 ball. This leads us to the crescendo, if you will, of the fair tax as it relates to our national debt. Transparency. With one fair tax national rate and prebate schedule, any changes to the tax system under the fair tax will receive unprecedented sunlight, scrutiny, and public interest. Currently, there is federal spending, but there is also the ability to reduce net treasury receipts through the tax side of the ledger, so to speak. For example, that's a hard concept, but let's dive in. For example, 75% of home interest deductions only benefit the top 20% of U.S. earners. This is one of the largest components of the roughly $5 trillion in reduced income tax base referred to earlier, which reduces our Treasury's pot of money, so to speak. But it is not a federal spending earmark per se, because the check going out the door is not to a vendor or supplier, but to you and I who itemize our home interest deduction in the form of less taxes payable to the U.S. Treasury. It's a collection earmark, if you will. This tax side of the ledger will be completely eliminated under the fair tax, meaning that a great deal of the smoke and mirrors of the current income tax system will be completely gone. Only true federal spending will be at issue, which will, by default, receive heightened attention and scrutiny. The existing phenomenon of our country's deficit spending, however, will not easily go away, even with the fair tax as the law of the land. Currently, because our U.S. government can borrow, and both sides of the aisle are extremely adept at this, we can borrow to cover all of our deficit spending year after year. The need to urgently balance our budget escapes attention because there's always money in the bank to spend on our federal programs, by about $1 trillion a year for the last 10 years. It's interesting but true that our total $23 trillion federal debt has grown by about 100% in the last 10 years. It's doubled in 10 years. The fair tax will systematically result in greater Treasury receipts based on everything we've gone through tonight. But the actual federal spending well beyond our Treasury receipt levels could persist. The only limitation here are the politicians of every ilk and their ideas for federal spending programs, some of which are getting increased attention as the 2020 presidential campaign season hits its stride. Let's take a different tack, though. After fair tax enactment, if a crafty politician wants to exclude certain expenditures from the fair tax to pander to a particular group, for example, let's exclude all purchases of prescription drugs and medicines from the fair tax. He or she will need to either reduce the prebate, good luck getting a groundswell of political support for reducing that prebate you receive every month, or they'll need to raise the uniform fair tax sales tax rate. Again, not a likely winner with the U.S. public, given every person who consumes in the U.S., which is everyone, would be personally affected. This fact, along with the protection of the prebate, which untaxes spending on life's necessities, provides an incredible natural disinfectant to future political meddling with a thoroughly researched fair tax plan, which, by the way, has over 22 million of non-political grassroots research to back up its contentions and is the most researched piece of draft legislation in U.S. history. Another point on transparency is that now, under the fair tax, all federal taxes you and I would pay are visible on the receipt of our newly purchased goods and services. Currently, under the income tax system, the average goods we purchase, it has a cost that is comprised of 22% embedded taxes. This varies by industry, of course, but when we purchase at the retail level, we're paying an immense amount of federal income taxes that have been passed on to us from businesses, corporations, and their related federal business and payroll matching tax burdens along the supply chain and through production. Under the fair tax, we'll pay our full federal burden at the retail level when making purchases, except now we'll be able to clearly see what we're paying rather than it being shrouded throughout the production cycle, manifesting itself as increased but hidden costs of the goods and services we consume every day. So let's go to conclusions. And to conclude, I'd say the fair tax is not a spending plan, but a more efficient and effective way to collect the same U.S. Treasury receipts we collect now under the income and payroll tax system. It's called the fair tax, not the fair spend. That being said, while not directly affecting our growing national debt, the effects of fair tax enactment, including drastically reducing tax evasion and by default increasing tax receipts, a booming economy, the likes of which we've never seen, and by default increasing tax receipts, reduced compliance costs and related hours, and by default more time spent on productive initiatives, resulting in economic expansion and ultimately increased tax receipts, all result in a perfect incubation chamber to reduce our national debt. The easiest way to get out of debt, after all, is to make more money as opposed to spending less, as most all of us can likely attest in our personal lives. Although Dave Ramsey and Clark Howard might disagree as to the best path of how to get out of debt, it remains a truth. However, if our insatiable appetite for increased federal spending does not decrease, or at least find equilibrium after fair tax enactment, the fact that the fair tax will by default bring forth the greatest amount of sunlight, transparency, and scrutiny to our federal spending that America has experienced in recent memory will undoubtedly lead to at least a moderate curtailment of our runaway federal spending and ballooning national debt. The fact that the tax side of the ledger will be forever eliminated, along with the fact that tinkering with the fair tax rate or reducing the prebate percentages will most likely be non-starters with the Americans and most American public, this helps to ensure that the construct of the fair tax remains unchanged. This solidifies the tax collection system, ushering in efficiency and effectiveness with little to inspect, scrutinize, or question in future election cycles. This would now leave the entire country and politicians from all sides to spend their energy on true spending of our federal government, including to whom, when, how, and why, and of course, how we should match those federal expenditures to our overflowing Treasury coffers, thanks to the passage of the Fair Tax Act. Ron, that concludes my prepared presentation, and let's open it up to Q&A.
Well, let's see. We've got a good question from Randy. Could Bitcoin and cryptocurrency increase income tax evasion?
Yeah, I think that's a good question, but I think it comes down to the simple equation. Whether you're paying with a horse, whether you're paying with Bitcoin, hard cash, a credit card, or whatever means you want to pay, a retail business that sells an end-use consumer, not used items like a Bitcoin with eBay or something like that, but a retail end user. Remember, the vast preponderance of retail sales happen with very few businesses like the Walmarts, Targets, Best Buys, Starbucks, Amazons, etc. And when you make a sale, you've got to collect your tax. Whether you receive your payment in Bitcoin, cash, or credit card matters little as far as that equation goes. Now, on the fringes, if you have prostitutes who are going to, get paid in Bitcoin from their customer, let's call him John for a second. I couldn't resist that. Of course, there's going to be evasion on the fringes. But how many retail end use products or services, is that going to be? And is it going to be, based on sales tax evasion studies? It's going to be infinitesimal, much less inconsequential evasion compared to our 700 billion a year evaded now. So I don't think so, but Randy, interested if you think otherwise, but I think the vast majority of retailers are going to collect their tax no matter how they're paid.
All right, Randy's got another good question here. Are Roth IRA holders hurt by the fair tax as they have been income taxed twice on their contributions?
Well, let's take a Roth IRA. So on a Roth IRA in our 20s and 30s and 40s and 50s, we earned income and we paid tax on it, and we put in after-tax dollars into a Roth, and that Roth grew tax-free up into retirement. And when you look at Roth IRAs, let's say we put in 30,000 over the years and it grew to 500,000. That's the normal ratio on Roth IRAs, meaning the vast majority of that Roth IRA is tax-free earnings and appreciation. So that aside, I think the question is, and it gets into generational equity, what if over the years I earned income and paid taxes, and then the fair tax is enacted and I die and I bequeath everything to my son or daughter, through a will? Well, isn't that unfair? Because now as they spend it, they're going to be taxed. Same kind of concept that Randy's getting at there. And what the experts show and what the studies reveal is, well, yeah, you're going to be taxed, but as you spend, the prices of everything have come down drastically, as we talked about, because of the elimination of embedded taxes. You've kept your whole paycheck. You've got the prebate. So even if you, there's a transition period, if you will, because some amount of earnings that you paid income taxes on will be spent post fair tax enactment, where you kind of get the double dip that Randy's getting at there. But all the other benefits we just talked about outweigh that inequity, if you will, at that cutoff time. And after a period of a few years, that completely goes away.
Okay. We had another question or comment in the chat box, again from Randy. What, if any, taxes do companies or I think that's supposed to be corporations pay? But that's an old concept with the fair tax, but it's worth addressing again.
Yeah. So again, we say there's 100 million businesses in the U.S. and you're probably thinking, wow, there's only 330 million people, but there actually are, when you consider every, home business, personal business, sole proprietorship, small business, there are 100 million businesses. 97.5 million out of the 100 million will have zero taxes to collect, remit, or pay.
Wow.
The 2.5 million businesses that are retail end user consumer businesses. Oh, and by the way, the reason that is most businesses sell to other businesses. And if you sell a widget to another business, you don't have to collect the sales tax. Remember the fair tax. The fair tax is only collected at the end user retail consumer level. So for example, at my accounting firm, just pretend for a second, I was performing a service, a consulting service. I was going to say a tax return service, but there wouldn't be any tax returns under the fair tax. But a consulting service for a company, I wouldn't charge the fair tax because that company is not the end user. The company, when it finally sells a widget, or when the company sells its services to, Amazon or Walmart, when it finally reaches that end user level, that's when the fair tax is collected. So corporations, businesses have no partnership tax, no corporate income tax. There's a 0% income tax rate. And for those, sometimes in the media, you'll see, well, it's not fair. Those rich corporations, they need to pay their fair share. We need to remember that corporations don't have a heartbeat. They don't have a home with children. Corporate taxes manifest themselves in higher prices for you and I at the register when those corporations ultimately result in a product or service being sold to us at the consumer level, and or a combination of reduced R&D. That means less innovation, less advancement, less productivity, or less employee wages, or less ownership distributions, which lowers our 401k and Roth returns when we're in retirement. Those are the real effects of corporate income taxes. And with a 0% corporate income tax, just imagine Ireland. It reduced its corporate tax rate to 12%. Companies flocked there in droves. Imagine USA as the tax haven with a 0% corporate income tax rate. It will be a tax haven unlike anything ever seen.
It's interesting what you said about the vast majority of corporations sell to other corporations, but when I think back, my wife and I drove a commercial truck, an Expediter, from 1996 to 2001. And most of the time, we picked up at one company and brought it to another company, parts, auto parts, or whatever they are. Rarely did we deliver to like a Home Depot or something like that. It was very rare.
Yep.
So yeah, that makes sense.
Yeah, your business, Ron, you and Elaine had zero retail services. Even if your customer is Home Depot, Home
Yep.
Depot is not the end consumer. Home Depot's, Jade coming in on the weekend to buy a product. That's the end
Right.
user consumer.
Yep.
Ron and
Yep.
Elaine selling to any business or Home Depot. In your circumstance, there would be no taxes whatsoever.
Okay, David Richardson has a question here. Not an accounting question, but could the fair tax be implemented by a convention of the states only, therefore keeping our dysfunctional Congress out of the conversation?
It's a good
Oh,
question.
yeah.
You know,
Yeah.
David's a wise guy. He's from Broken Arrow, Oklahoma. And so I have a warm place in my heart for anyone from Oklahoma. So great question, David. What do you say, Ron? How do you answer that?
Well, I have said before that I'm very much in favor of the Convention of the States, because if they are successful in repealing the 16th Amendment, the fair tax is the only game in town. It's the only answer to the federal taxation. It's the only one with over $20 million worth of research. It has more co-sponsors than the Tax Cuts and Jobs Act had in 2017.
Right.
Okay. And it has more history. So I'm very much in favor of the Convention of the States, and I hope they are successful in repealing the 16th Amendment, with their other objectives, because that would leave the door wide open for the fair tax. The only thing that could maybe be close to that is also repealing the 17th Amendment. But yeah, I think it's a great idea, and I think people should get behind that. So
Agreed. And Randy had a comment on this one, and this is why we need lawyers. Randy says all tax and revenue bills have to start in the House. It's a requirement, but
yeah.
the repeal of the 16th Amendment could happen with the convention of the states.
Yep.
Yep. Oh, and then the other question was a follow-up on corporate taxes. And the question was, if businesses pay taxes, would they just not pass them on to consumers in embedded cost? That's what's happening now.
Sure.
Under the fair tax, corporations aren't paying any taxes. Retail consumers like you and I walking into Walmart or Home Depot, we pay the fair tax. The 2.5 million out of the 100 million businesses in the US, only 2.5 million will simply collect and remit the fair tax to the state taxing authority and then the federal government, and they'll keep 0.25% for their troubles. So to answer this question that came up in the chat box, currently corporations pass it on to us in embedded taxes. That goes away under the fair tax.
Yep. Jade, are you done with your PowerPoint?
I am.
Okay, I'm going to load a slide with.
There's a picture of Ron. Oh, there you go. You guys missed it.
Okay. I just want to remind people a couple of websites to pay attention to. Fairtax.org/1040. You can go to that site, and if you want to support the people at the national level, the Americans for Fair Taxation, this is a great way to do it. It'll ask you to commit to donating $10.40 every month, and those recurring donations are very important to the Americans for Fair Taxation. Also, Bob Paxton and I have a weekly show called Fair Tax Power Radio, and we now have our own website, fairtaxguys.com, in which you can look up the most recent shows. It is a video show, but it also shows up on Spreaker, Apple Podcasts, and iHeartRadio as a podcast, which comes out every Friday morning early. And then a great website in which you can weigh in not only on the fair tax, but any other pending legislation is popfox.com. It's free. You have to give it your name and your address, because that way the system knows who your representative and who your senators are. And then you can go in there, you can look up HR 25, and you can tell them how wonderful HR 25 is. And you can also look up other tax proposals and tell them why they're not as good as HR 25. So that's a couple of things to keep in mind. Okay, I see we have another one in the chat box here. Okay, is all education untaxed from primary school to college? Well, Jade, you want to answer that?
Yeah, I've read in the FAIRtax Act itself, and Randy, correct me if I'm wrong, I think it's secondary education. And I could go get it off my shelf real quick. I think it's secondary, meaning like college and beyond, if
Yeah,
I'm
okay.
not mistaken. So like if you paid private school for your, ninth grade son or daughters, I don't think that is included. And Randy, you can correct me there. I think I recall in the act it's secondary.
Okay. All right. We're going to wrap this up. I want to let everybody know that this webinar will become a video. And that video, when it's available on Web Ninja, I will download it and put it on the Florida FAIRtax Educational Association site. There's a section there for past webinars, and this webinar will join them. And also in December, we're going to change things up a little bit. We're going to kind of, as right now our plans are tentative, but I think we're going to bypass the webinar portion of it and go straight to the video. All right, that is the feeling right now. We don't have any definite plans, but I think the days of the webinar for this presentation, I think we can do better with a straight video. So, but anyways, let's see. There's a couple more questions. Okay. David says, thanks, Jade. Fantastic job. Okay.
Thanks for chiming in, David.
Okay. All right. I don't think there's any more questions. Let me scroll down here. Nope. I think we've handled all the questions, and we've reached the top of the hour, and I think I'm going to let people go. So I want to thank everybody for joining us, and look for. I'll be sending out once we get this on the Florida FAIRtax website. I'll be sending the link out over YouTube and Facebook and any other venue via email and stuff like that. So thanks, everybody. Thanks for joining us. That's the end of the webinar tonight. Jade, wonderful job as usual. There's a lot of information there. I know I'm going to have to watch this video again because there's a lot of information packed in there, and it's very valuable. I always learn something when I listen to you. So thanks a lot. And we'll see everybody in December.
Thanks,
Thank
Ron.
you. Jade, Jade, hang on for just a second after I stop the broadcast, okay? All right.